Ladies and gentlemen, welcome back to our Talking Numbers Investment Plus podcast series. My name is Paul Jantz, and we hope you enjoyed the first episode of this new series. This is a brand new series. We brought you Talking Numbers Property Plus, and this is our Talking Numbers Investment Plus. It's brought to you by Virtual Financial, making financial advice affordable to all Australians. I am chatting to their CEO, Adem Becirevic. Adam, how are you? Welcome back.
Yeah, good, mate. Fantastic.
That's good, mate. I might just delve a little bit deeper as well with you as the CEO and founder of Virtual Financial. Now, before we get into episode 2, tell me, Adam, why did you choose a career in the financial services industry? I think you mentioned in the first episode you started as a CPA, so you started as an accountant and switched over to being a financial planner. Why did you choose that?
Yeah, it's interesting, Paul. So I worked in tax as a CPA for some of the big firms in Melbourne. But what I found was being an accountant and tax is that you're always talking in the past, in history. I'd more like to work in the future and try and help people where they get excited about having enough money for retirement, getting that investment property, getting that investment portfolio, and talking about the future. So for me, it's just a great way. I love helping people, and I see financial advice, and I just saw the industry back then. I think it's definitely changed now in regards to becoming a lot more professional, but I thought I had a lot to offer with my tax background to really help our clients. So a lot of the clients that see me don't need to go back and ask their accountant a question. They can just kind of, because obviously I have the tax background, qualified CPA and tax agent, I can give the advice that they need all in one meeting.
That's a good point, isn't it? Because you sometimes don't realise the tax implications to these sorts of things as well. And I know in our Property Plus series with Jay Anderson, we touch on it. Obviously most people, I think as we grow up, whether it's playing the game of Monopoly as an example, where I do it with my kids. So you start getting into buying property, renting property, getting rent. You start, my kids are 12, 10 and 7, and we're doing that now. So I think most people would like to have a property portfolio, an investment portfolio, but there's tax implications to all of those. And I think that's an important point that you just raised. So having your expertise of doing both is really important.
No, it certainly is. And the clients really appreciate that.
Yeah, I can imagine. Mate, before we get into episode 2, let's do a bit of a recap of episode 1. So to all of our listeners that have joined us for this Talking Numbers Investment Plus series, what's your top 3, and it doesn't need to be 3, but I'm just sort of going out there. What's your top 3 from learnings that you can share with everyone from episode 1, which was retirement?
Yeah, look, Paul, I think it's really important that, the number one thing is that clients actually go and get advice. Go and get financial advice. It doesn't have to be with Virtual Financial, even though we'd love you to come here, but go and get advice from someone. I think it's really, really critical, and as I might have said it in the last episode, is to, take one day off a year for your financial affairs, making sure that, your financial plan's in place, your retirement plan's in place, your will's in place, your taxes done. So just making that effort one day a year. And the last thing, the third thing would just be to do the 5-minute questionnaire. I think that's really important. It's on our webpage. There's no cost to it. We'll send you the results, and we can help you from there.
Yeah, mate, just a fantastic bit of advice there. That bit where that one day off, one of the things that I know that I used to do in the past, and I still do it today, is, and I love what you said before, is about the reason why the reactive to the proactive, looking back to looking forward. That's why you left the tax industry to become a financial advisor. That's one of the things that I do as a continual habit, and that is every quarter I go on a holiday, and at that holiday, and I take my 3 boys with me, and at that holiday we plan our next holiday. So there's a classic example of, we get burnt out. I know we've been locked down here in Melbourne. We're coming out of COVID. There's all crisis going on with the airlines and people trying to travel as well. It's a nightmare.
Yeah.
But the ability to get away and switch off and look at all those key things, we'll get into things like wills soon. And I'm staggered with the statistics that you can share with regards to, 9 out of 10 people don't get financial advice. I'm staggered at the amount of people that don't have a will. So we will get into those sorts of things, but as long as you can take that time out with your partner, plan it, I think that is a great piece of advice. So to all of our listeners, hopefully, these are the little golden nuggets that we hope that we can share with you to educate you on maybe what you can start thinking about and maybe start doing as well, because it's one thing to listen, it's another thing to implement. So hopefully we can provide you with that little bit of just a little bit of a push towards doing something that you may not have done before. Adam, let's talk self-managed super funds. So episode 2, we're going to talk about the benefits of self-managed super fund, but let's maybe start with, and I struggle to say SMSF, although I said it just then. So, so I'm going to talk about, let's go into the benefits. We spoke about retirement. Our super plays a major role in that retirement, which you spoke about in episode 1. We have retail, we have industry, which we will cover a little bit later in this series as well. But we also have self-managed. And a lot of people may not know about this, but why would someone move to a self-managed superannuation fund?
Yeah, it's a good question, Paul. Look, the main reason is for clients to move across to a self-managed super fund is they've potentially had enough of, industry funds, getting no advice, funds really going nowhere, and they want to have a bit more control over their destiny. So with a self-managed super fund, you're the trustee, and it's up to you to make sure it works. So people that are proactive and people that want to do alternative assets, potentially, like they're buying a residential property, buying commercial property, having an MDA, those sort of investments, private equity. There's so many different plays you can do with the self-managed super fund. And I think the major one really is having that diversification of asset classes you can really go into, because in an industry fund, you can't do private equity. Industry fund, you can't buy a house. So it just gives you a lot more freedom to do what you want to do, and you're in charge of what happens. So in an industry fund, the industry fund is in charge. They're the trustee, and I can give you a very quick example of the difference. We unfortunately had a client die last year. They had an industry fund as well as a self-managed super fund. The wife rang me in hysterics. Husband's just died. She's tried to get money out of the industry fund to pay for the funeral. They sent her 50 pages of forms to fill in. They wanted a death certificate. They wanted this. They wanted that. It would have taken forever to get the money. She come in and saw me. I said, well, don't forget, your husband also had a self-managed super fund. You're the trustee. You can do it, within reason. You can transfer a death benefit payment to yourself straight away. So we were able to transfer $30,000 to her straight away to relieve all that stress and pressure. So having a self-managed fund really gives you that flexibility to not rely on other people, ensuring they do the right thing because you're in charge of it.
Okay, it's interesting because I know I've heard the term. Obviously, been in the accounting industry for a very long time. I've heard the term self-managed super fund. So, and the ability to buy properties and alternate assets, as you mentioned, and so it's going to be good to break through this, because I'm looking forward to learning a little bit more about all of this, as well as I'm sure all of our listeners are. So you mentioned just before with regards to, let's say, a trustee, and so I'm going to ask this question again just to make sure that we did cover this. So what actually is a self-managed super fund?
Well, it's a trust fund set up. You can have up to 6 members in the fund. Generally speaking,
6 members. Okay.
Members. Generally speaking, it's just the mother, normally just the husband and wife would
Right.
set up a fund, and you're the trustees of the fund. We would always use a trustee company for the fund, and it just gives us and the clients the opportunity to invest in other assets. So we have an MDA, managed discretionary account, that we use. I
was going to ask you that because you used that term before. I was going to ask that. Yeah. So an MDA is a
managed discretionary account that we use for our clients. And it's the safest way you can invest, because under an MDA, basically the asset is in the self-managed fund name. So it's not in the trustee name of of an industry fund or like that. It's actually in the name of the self-managed super fund. And so we use that portfolio to really help our clients invest, and and through the MDA, the managed discretionary account, we were able to manage it for them 24/7, and we were able to make changes at any time required. So if the market goes down or we need to change to cash or more to fixed interest or whatever, we can make changes at any time. So a self-managed fund just really gives clients the opportunity to really have their funds invested the best way possible.
So if you wanted to, sorry, you finish.
No, and in my opinion, once you get over that, the $400,000 market really becomes very cost effective as well.
Okay, yeah, we'll get into some costs in a second because that's a big one with regards to the cost v benefit, I suppose. But so as an example, I could set one up with my wife and two other family members, let's say her sister and her husband. And so we would pool our industry funds into a self-managed super fund. Let's say we had $100,000 each in that fund.
Yep.
We could pool that into one fund that gives us $400,000 into a self-managed super fund. And then we would work with you to invest that. So we could buy a $350,000 property with that. And then the self-managed super fund would own that investment property.
Yeah, correct. Or we could invest some of it in NDA and we can maybe just put down 200,000 of that towards the property purchase and borrow the other 200,000. So
that was my next question, actually. Can you borrow?
Yeah, so you can. So you can definitely borrow to buy property in a self-managed super fund. And not just property, you can also do it for shares as well. We have a product we use as well that does shares, but you can also do shares and you can do property. So it's quite, obviously, you're leveraging. So that the more you've got invested, obviously the higher your gains can be. But obviously the other side is true as well. That obviously your losses could be higher as well. But you get that leverage effect. So you're leveraging your money, and if you get like we've just had a big property boom where property gone up $200,000-$300,000. You can get some really good windfalls there. A lot of our clients have. So it's been time for them where they've seen their properties go up $200,000, $300,000, and it's gone up that much because of the leverage.
Yes. Yeah. And look, the comment you made before with regards to diversification, that's probably the biggest one, because I know I'm in an industry fund now, and you get, and I'm going to go into a little bit of detail about this because I'm going to use myself as a good example in terms of the what I don't have access to, I suppose, and the diversification that I don't have access to. And so it's a really interesting one, because you also mentioned before that your industry fund going nowhere, and I sort of wrote that down. How do you know it's going nowhere? Just from pure growth?
Are you talking about industry funds?
Yes.
Look at the end of the day, it depends on what industry fund, obviously. Some industry funds have done quite well, but I think it's more about really the lack of diversification and also not getting the advice is probably more the case. They have good returns. I'm not saying they haven't, but I think it's more along the lines of the asset diversification, the getting no advice, and like my client found out last year, getting no help when you need someone. You've got no help. They send you 50 pages of forms and say, please fill that in. I mean, to me, that's not really helping you. And, when the markets are going down, like a lot of the funds have dropped 10, 20%. I've seen this with some of new clients we've got. Some of the funds have dropped 20%, and, there's nothing. There's no news about it. So they only talk when the funds are going up. They don't talk when the down. So it's very interesting the way they do it, and with industry funds also is they don't have to value their assets every 3 to 5 years. So when there's a property downturn like there might be soon, they just don't revalue their assets. Whereas obviously when you've got an MDA that we use, a managed discretionary account, assets are valued daily. So it's a lot different.
Right. Okay. Again, interesting.
So they've got a lot of little tricks that they can kind of hide their non-performance.
Yeah, I can imagine. So let's get into that, because I suppose sort of one of the key things, I suppose, is cost versus benefit. Talk me through the costs and maybe some comparisons to, let's say, a retail or an industry fund, where sometimes costs could be hidden, as you just mentioned.
Yeah, exactly. Look, costs are a very, I suppose, on a podcast, very hard to go over. But basically, if you set up a self-managed super fund, there's definitely, you set up a trustee company, you set up a self-managed super fund trustee, and then if you buy a property, then there's also a bear trust and another trustee company. So so your costs could be anywhere between 5 and 10,000 to set the thing up. So it's not cheap to get the SMSF set up, but once it's ongoing, the cost can be pretty good, especially once you get over that $40,000 mark in regards to driving a self-managed fund versus a industry fund. So we find in most cases, once we get over that $40,000 mark, we really start to see significant changes in costs. So really, with a self-managed fund, you probably only really looking at using one if you've got somewhere $300,000 plus for a
Right.
That's when you start to really get the benefits from a cost point of view, and obviously as that goes higher and higher, your benefits are much greater as well. But also, obviously with the self-managed fund, you have access to the MDA and have access to other assets that you can't normally get hold of. And obviously the number one, I suppose, one is that Australians want, and they all want, is residential property. So they have access.
Yes.
They have access to that if they're keen to do it.
Yeah, look, I think as you just mentioned there, just to touch on that. So to set up a self-managed super fund, you're looking at an annual cost of anywhere between 5,000 to 10,000. Is that an annual cost, or is there initially the setup could be higher, but then the ongoing could be a bit lower?
Yeah, correct. That's the setup, and then obviously the ongoing. So the ongoing, you've got two expenses. One, you've got the accounts and the tax return and the audit to be done. That's normally around $2,500 a year, and then you have the fee you pay the advisor. So depending on what you do and what investments you have is depending on what you pay the advisor. But generally speaking, that could be 0.8% of the funds invested.
Right. Okay. Good. And so the other main point there to all our listeners, ideally have $300,000 in your industry fund before you wish to flip that over to a self-managed super fund.
Yes, correct. Yeah, you want to have at least that. It's just not feasible. I mean, you'd set one up if you've got lower amount, but if you knew the next year you're going to be plonking, if you only had 200,000, but you knew next year you've got 100,000 coming from a sale of a house or something like that, you might want to plonk an extra $100,000 in there, so that's coming. So you might just set the fund up in getting ready for that event.
Right. Okay. Good.
Yeah.
Now you mentioned trustees before, and you sort of mentioned company trustee. Now I've heard people talk about an investment plan. Is that something that is important when having a self-managed super fund?
Yeah. So like clients when they have a self-managed fund have to have an investment strategy, and we work through that with them. And then from there, we also do, so part of the whole setup actually require you to do a financial plan before you actually set the fund up to ensure that what you're going to do in regards to how you're going to invest your money, how you're going to protect any debts. So you need to look at insurances. So you'd have to have a whole plan done in place. So there's to be a plan done before you actually set up the self-managed super fund. So in regards to what you're going to do, you're going to invest in MDA, you're going to buy a property. Okay, how does that look? Okay, the property you're going to buy, I mean, what rent you're going to receive? I mean, is there a shortfall? Have we got enough cash flow? Can we fund this? So there's a lot of moving pieces. So a self-managed fund, you definitely need to get advice to ensure that you're ticking all the boxes, because obviously you've got a lot of boxes there to tick. Government in regards to being a trustee and your responsibilities and getting it done right. So, but we go through all that with our clients.
Okay, and I think that's it's probably a really important one, because some people can go, well, you know what, I'll set up a self-managed super fund and invest in crypto. Now, crypto could also lose all your retirement savings. So that's why you've got to make sure you have all that investment plan and that financial advice in place as well to protect you from that. Is that fair to say?
Yeah, it's very important. Like when we talk about alternative assets, and we probably put crypto in that basket. We normally explain to clients we don't want to have any more than 10 to 20% as a maximum in one asset class like that. And I do find, and I've spoken to other accountants and so forth, where clients have just gone off and put virtually their whole fund in crypto. And a couple of months ago when it dropped by 50%, their portfolio dropped 50% overnight. So it's not ideal.
Yes.
That's where getting advice and taking the so by getting advice, you're taking the emotional out of it. So rather than rather than being emotional about it, and people that when they've lost money in crypto, they'll just double up because they've got an emotional. We come from a cognitive point of view where we're just doing it based on facts, and we don't have any emotion in regards to their funds. We're there to make sure that their funds are invested the right way as per the investment strategy that we set out for the client from the start.
So can they deviate away from that investment plan because it's self-managed? So can they make that decision, or is that something that they still needs?
They certainly can, but then they need to go back and adjust their investment strategy.
Okay, good.
And they need to get advice. So obviously I wouldn't be supporting someone putting 100% into crypto.
Yes.
And I don't think many advisors would. So, but again, I'm not against crypto. I'm not against property. I think just everything has to be done in moderation as per the investment guidelines.
Yeah, well, that's exactly right, and probably if anything balanced. And I think you mentioned a really good point then that I think, did you say, just to confirm, that you said not more than 10% in a different asset class, like an alternative asset?
Yeah, 10% is what I like. But some clients like to dabble a bit more, and I think probably no more than a maximum of 20%.
Okay, good to know. So 20% into an alternative asset class.
Yeah,
good stuff. So, mate, we've covered things like the trustee with the investment plan. We've covered things like what would someone typically invest in. So I think you went through that, but what are the top three things that you would see clients investing in their self-managed super fund?
Yeah, okay. Well, I suppose the number one would be residential property.
Okay.
Clients like residential property. They can feel it, they can touch it, and that, obviously is the number one asset class in self-managed super. For us, obviously, we love our MDA, our managed discretionary account. Our clients do as well. It does very well, so that would be probably the second biggest investment that we would have. So it'd be probably property and our MDA, and then our third would be probably some of our clients do like to invest just in direct shares. So the direct shares can also be something that clients, because they're not self-managed fund, they sometimes like to, hey, I'm going to pull X amount aside and just do some direct investing themselves. And obviously, we help them where we can. But I think they're the three major kind of investments we see through self-managed super fund would be the property, direct property, the MDA, and direct shares.
Yeah, good. And I think that's when you talk about direct property, you've obviously got your house that you live in. So you're talking about any further investment property. Correct. This gives you greater options and the borrowing ability in a self-managed super fund.
Yeah, exactly. So as I said, clients love property, and it's a great way to invest. Obviously, I'm not against it at all. I think there is probably some parts of the market where I've seen I've been in the game now for over 30 years, where a lot of accountants and maybe advisors are negative property, but I mean, obviously the last 30 years property's done pretty well, so I think it's a good asset class to hold.
Yeah, look, I would agree, and just based on even just listening to Jay Anderson in our Property Plus podcast series, I think the critical parts to all those sorts of things are making sure that you've got the right advice again. So going to experts and basing it. Properties, you can get a lot of information from statistics, and the stats will provide you with what are the areas that are not overpopulated, that are going to grow, that are there's a lot of great things. And that's why if you're unsure yourself, and if you're listening to this now, go and have a listen to our Property Plus podcast series as well, where Jay spoke about some fantastic and gave some fantastic educational strategies that you can use if you're considering buying an investment property as well. And I suppose what Adam's saying is, what I'm hearing is if you're considering doing something, consider how you can do that in a self-managed super fund as well.
Yeah, exactly, Paul. And I think with a self-managed super fund, you can use a buyer's agent. If you're not an expert yourself, but you really want to buy that investment property, seeing a buyer's agent's the way to go. And that expense will be covered by the self-managed super fund because it's for the self-managed. Yeah. So I think, if you haven't got the expertise or you haven't got the time, I think, listening to that podcast is really important, because a lot of people that I talk to, a lot of clients that I talk to, when they're going to do their own, because we don't provide property advice in regards to, go and buy this property. We don't give property advice. We just do the numbers. So we once the client's found a property or they've got a pre-approval, we can do the numbers to show them how that's going to look for them. So what's going to cost them each week, and how that projected return is going to look in 20, 30 years. So we do all that part for them. But I think it's really important that a client, if they're not sure about property, is to see a buyer's agent, because as I was saying, a lot of our clients, they'll tend to, if they, let's just say they live at, Ascot, well, they'll only look at really properties around Ascot, and because that's all they know. But by seeing a buyer's agent, there could be a lot of better opportunities in other places. Ascot's a great spot, but you don't want to. Again, it's diversification. You don't want to have both of your properties in the one area, but that's what most people do, and it's not the right thing. You need to diversify. You need to go to a different suburb away, because that suburb might outperform, even though because you're emotionally attached to that suburb. You want to get out of that emotion. That's why you use advisors, because we work on a cognitive rather than emotional. And that, again, I highly recommend Jay and Francis. They're terrific.
And that's a major part of what you just said then. If I could just highlight that for a second, the word, you've used it twice now, emotion. Most people, if they're gone to buying a house, and we all have, you get emotionally involved, and where the house may be only worth $350, suddenly you end up spending $420 because you're emotionally involved. Where a buyer's agent will say, no, don't worry about it. It's not worth more than $360. Don't pay more than that. We'll find a better one with a better return. Don't worry about that. But and that's the great part about. And again, one of the great questions I asked Jay as well was, Jay, if I've got $1.5 million to spend on an investment property, should I buy one property or should I buy three for $500? And back to your point, it was about diversification. He said three. We'll find you three different growth areas that are providing great yields with rental returns. So again, it's about diversifying where your property portfolio may be, as opposed to one in Ascot, as an example.
Yeah, exactly. So makes a lot of sense.
Yeah, brilliant, mate. Brilliant. Look, thank you. As we wrap up this episode 2 of our Talking Numbers Investment Plus series, and we've given Jay Anderson a plug there as well. So reach out to Jay Anderson or do a search for him as well if you want to know more information there. So, mate, before we get into our tackling the next topic, tell us about what we're going to talk about in episode 3, Adam.
Yeah, mate, I'm going to talk about assets and why to protect them. Why we should, insurances, what type of insurance we should have in place, and how we can protect those assets and protect our wealth.
Yeah, brilliant. And it's a pretty important topic to talk about, so that our assets are protected. It's a funny thing that I think a lot of us, I know we've got the Medicare system, but a lot of us also then go and have private health insurance, but we don't worry about all of our other key assets that we need to protect along the way. So it's going to be a fantastic topic to get into in our next episode of Talking Numbers Investment Plus. Adam, thanks again for joining us, mate. Again, our exciting new series of Talking Numbers Investment Plus. To all of you that are listening, thank you for listening into this episode 2. If you haven't heard our episode 1, go back and have a listen to that as well. And hopefully you'll listen to episode 3 as well, as we get into asset protection next. Thanks, and enjoy the rest of your day.
Thanks, mate.